Hi friends, we will discuss today about depreciation. So today's agenda is we are going to learn about depreciation. Now, first of all, let us learn the meaning of the term depreciation. What do you mean by depreciation? Depreciation is the measure of fall in value of a depreciable asset due to use, due to effluxion of time, and due to obsolescence. I'll repeat the definition for you once again. Depreciation is the measure of fall in value of a depreciable asset due to use, due to effluxion of time, or due to obsolescence. So what is depreciation? See, depreciation is related to depreciable assets. In a business, we are going to use a lot of depreciable assets. We are going to use buildings, factory building, office building. We are going to use machinery. We are going to use computers. We are going to use furnitures, and we are going to use many such assets. Now, these assets, when we use them regularly, there is some wear and tear. Slowly the value of these assets keeps coming down every year. So there is some fall in value of these assets. When we measure the loss in the value of the assets, that measurement of the loss is nothing but called as depreciation. So what is depreciation? It is measurement of loss in value of depreciable assets due to use, machinery, furniture, computers. As we use them regularly, their value keeps reducing. So depreciation is the loss due to use, effluxion of time. There are certain assets which lose their value as the time passes by. So again, some loss is caused due to passage of time. Assets like building. If you take the example of a building doesn't lose value due to usage. As the time passes by, the value of the building keeps coming down. We all know that. So the loss in value of building is not due to usage, it is more due to effluxion of time. And certain assets become obsolete. See, when the computers were invented, typewriters became obsolete. They became out of use, out of fashion. So the textile machinery, the automatic textile machinery has made the hand woven textile machineries all outdated. So when the machinery modernizes, or we can say when the technology modernizes, automatically the old machinery, the old technology becomes obsolete. So when the assets lose value due to either use or due to effluxion of time or due to obsolescence, that is due to technological changes and due to market changes, there is some loss in value of the asset. And the loss, when it is measured, that loss is called as depreciation. So I'll repeat the definition once again for you. Depreciation is the measurement of loss in value of a depreciable asset due to use, effluxion of time, or due to obsolescence. Okay. Now, what do you mean by a depreciable asset? We said the loss in value of a depreciable asset is called as depreciation. First of all, what do you mean by a depreciable asset? Now, to call an asset as a depreciable asset, it has to satisfy certain conditions. The first condition is the asset should have useful life of more than one accounting period. Let us take an example. Building, it is useful for more than 1 year. Machinery, it is useful for more than 1 year. Computer, it is useful for more than 1 year. Furniture, it is useful for more than 1 year. Vehicles, they are useful for more than 1 year. These assets can be called as depreciable assets because they have a life of more than one accounting period. So the first condition which a depreciable asset has to satisfy is it should have a useful life of more than one accounting period. The second condition to be satisfied is the assets should be used either in the production of goods or in the provision of services, or they should help us in doing our business. So the assets should contribute production of goods, or they should help us in provision of services, or they should help us in doing our business generally. Machinery, it helps us to produce goods. Buildings, it helps us to carry out our operations. So we can call them as depreciable assets. A chartered accountant who uses a computer. Computer is an asset for him because he is using the computer for providing services to his clients. So The two conditions have to be satisfied. I have just now discussed. The first condition is it should have a useful life of more than one accounting period. The second condition to be satisfied is it should be either used in production of goods or provision of services, or it should help us in doing our business. The third condition to be satisfied is the assets should not be held for resale. We have to hold these assets for using in our business, for use in production, for use in provision of services. They should not be held for resale. I'll give an example to understand this point. Let us say a company like Toshiba, which manufactures a lot of machinery. They manufacture machinery and they sell machinery. They make transformers, turbines. They make them and they sell them. The transformer is a machinery. The turbine is a machinery. It's a very heavy equipment. Toshiba Corporation makes and sells them. So if it is holding some transformers, if it is holding some turbines, if they are held only for resale, they want to sell it and get a profit. In such cases, it will not be called as an depreciable asset. It will be treated as goods. So if an asset is held for resale, it cannot be called as a depreciable asset. It will become goods. So assets have to be held for use, not for sale. So I'll repeat, we have discussed three conditions. It should have a life of more than one accounting period. Second, it should be held for use in the business. Third, it should not be held for resale. And the fourth and the most important condition is it should have a limited useful life. If an asset has unlimited useful life, then it cannot be called as a depreciable asset. Life should be more than 1 year, but the entire life should be limited. See, take the example of land. Land is not a depreciable asset. Why is land not a depreciable asset? Because it has unlimited useful life. It cannot be called as a depreciable asset. Land does not lose its value due to use, efflection of time. Land never becomes obsolete, it will never become outdated. That is why land is not a depreciable asset. So to call an asset as a depreciable asset, it has to satisfy four conditions. It should have a useful life of more than 1 year. It should be held for use in the business. It should not be held for resale. And the fourth and the most important condition is it should have limited useful life. So when an asset satisfies these conditions, it becomes a depreciable asset. The fall in value of these depreciable assets, it's measured, and that loss is called as depreciation. Okay, now the third thing, objectives. See, I think you would have already learned generally what is the entry we pass for depreciation. The entry we pass for depreciation is depreciation account debtor to asset account. We reduce the value of the asset by crediting the asset account, and the reduction in value of the asset is shown as a loss, and the loss is debited to an account called as the depreciation account. So the fall in value of the asset is credited to the asset account, and it is shown as a loss in an account called as depreciation account. We pass an entry, depreciation account debtor to asset account, and then the next entry we pass is we show depreciation on the debit side of the profit and loss account. So asset value is reduced and the reduction in value of the asset is shown as a loss in the profit and loss account. Now, why do we give this treatment? What is the purpose of providing depreciation? Why are we recognizing the loss in our books of accounts? This is the question that arises. Now, the objectives of providing depreciation, you can say there are three simple objectives. The first objective is the fall in value of the asset has to be treated as a part of cost of production. It has to be treated as a part of cost of goods sold. It has to be treated as a part of cost of sales. So when you are trying to calculate the true cost of production, you want to know what is the cost for the company for producing the goods. You want to know what was the cost of production of the goods which you have sold. You have to include the loss in value of the asset also as a part of your cost of production. If you include depreciation as a part of cost of production, the profits which you have calculated will be considered as accurate profits. So if you want to arrive at true profits made by a business, you have to include depreciation as a part of cost. You have to include depreciation in cost of production. then only then you will be able to calculate the correct profits. It's also a cost, it's also an item of expenditure like electricity, like rent, salaries, wages, etc. etc. It's also an item of expenditure. It does not involve outflow of cash, but still there is some loss in value of the asset, and that loss also has to be included in the cost to arrive at the correct profit. So first objective is to arrive at the correct profits. Second objective. The second objective is to show the true financial position in the balance sheet. Let us say, I'll give you an example. A company purchased a sophisticated machinery 10 years ago for 100 crore rupees. The company purchased a sophisticated machinery, imported machinery for 100 crore rupees. And for the last 10 years, the machinery has been continuously used for production of goods. And the life of the asset is over, let us say. Now, the accountant wantedly or he forgot recording depreciation. The asset has been used for 10 years. The value of the asset when it was purchased was 100 crores. It has been used for 10 years. Accountant wantedly, or let us say he has forgotten to record depreciation. What will happen if he has forgotten to record depreciation? He fails to record depreciation. What will happen? The consequence is the asset, the machinery will continue to be shown in the balance sheet at 100 crore rupees. It will be still shown in the balance sheet at brand new value. Actually, the life of the machinery is over. There is no value left. It may fall down on the head of a worker anytime. It is actually worth scrap now because its life is over. But still, because we have failed to record depreciation, the asset will be shown in the balance sheet at its brand new value, and that is not correct. So if you want to show the true financial position of the business, you have to show the assets at their depreciated value. Now what do you mean by depreciated value? That is the value remaining after subtracting depreciation. So this was the second objective. First objective was to calculate true profits. Second is to show true financial position. And the third objective is it helps in replacement of an asset. Charging of depreciation helps in replacement of an asset. Now, how does charging depreciation helps in replacement of an asset? This I will handle in a different lecture, not here. Briefly, when you charge depreciation, there is no outflow of cash, and depreciation is shown as a loss in the profit and loss account. Even though there is no outflow of cash, you have shown depreciation as a loss, as an expense. Without paying money, you are showing depreciation as a loss. So what happens is every year a portion of the cash gets blocked in the business, and after a few years the money accumulates, and this will help you in replacement of your asset. In detail, I will take a different lecture in the next or in the coming lectures. I will discuss how depreciation helps in replacement of an asset. Okay, so let us summarize whatever we have learned till now. Depreciation is the measure of fall in value of a depreciable asset due to either use or deflection of time or due to obsolescence. We have also discussed what do you mean by a depreciable asset. We have also discussed the objectives of providing depreciation. Now I think you would have the doubt, what do you mean by obsolescence? See, I will give you simple examples. Computers made the typewriters outdated. So you will say typewriters became obsolete, out of use when computers were invented. The sophisticated machinery manufactured by the Japanese for manufacturing cloth, the automated textile mills, they made the old textile mills obsolete, which were partly manual and partly automatic. So when technology changes, it makes the old machinery obsolete. When there is, let us say, when there is no demand for the product which is being manufactured by the asset, when there are market changes, when there is change in demand, the asset automatically becomes obsolete. Okay, now we said depreciation is the measure of fall in value of an asset. Now the question comes, how can we measure the loss? For measuring the loss in value of an asset, we have various methods. Now why we have various methods? See, we have different types of assets. We have buildings, we have machinery, we have vehicles, we have computers, we have furniture. All these assets are of not the same character, not the same nature. We cannot use the same method to measure the loss in value of all these types of assets. So we have various methods for measuring the loss in value of various types of assets. So let us discuss the first method, that is the straight line method of depreciation. Straight line method of depreciation. Now, this method is also popularly called as the SLM method, and this method is also popularly called as the fixed installment method. Now, under the straight line method of depreciation, depreciation is calculated using a formula. Depreciation per year is calculated using a formula. I'll just note down the formula here on the board and we'll discuss it once again. Depreciation for 1 year is equal to cost of acquisition minus realizable value divided by estimated useful life. I'll read the formula once again for you. Depreciation for 1 year is equal to cost of acquisition of the asset minus it is estimated realizable value divided by estimated useful life of the asset. So depreciation for 1 year is calculated using this formula. Now, under the straight line method of depreciation, if you calculate depreciation once, that is sufficient. You need not calculate depreciation again and again every year. So, once you have calculated depreciation, you can use the depreciation amount every year. Now, let us see the formula here. What are the parts of the formula? Cost of acquisition minus estimated realizable value divided by estimated useful life. What do you mean by cost of acquisition? When you are buying an asset, when you are buying a machinery, you are going to incur some costs. We are going to spend some money. We are going to pay the supplier the purchase price of the machinery. We have to incur some costs on packing, transportation, freight, insurance. So we have to include all these costs in the cost of acquisition. Purchase price, packing expenses, freight, transportation. Not only that, if you have paid any non-refundable taxes, those things also have to be included in cost of acquisition. See, the basic rule is all the costs incurred till the date the asset is put to use. All the costs incurred which have been incurred till the date the asset is put to use have to be included in the cost of acquisition. See, if you have spent some money on installation of the machinery, what do you mean by installation of the machinery? See, as soon as you buy the machinery, you cannot switch it on because it may fall on the head of any person or it may break the leg of any person. So you have to be very careful with it. You have to safely install it. We have to prepare that particular site, dig that particular site, put some concrete, wet concrete there, and make the machinery to stand on that wet concrete. And when the concrete solidifies, what will happen is the machinery will not move. So we have to incur some costs on the preparation of the site, on putting that concrete and fixing the machinery there. We have to give some current, electricity connections. We have to give connections for raw material, output. So we are going to incur some costs, that is called as the installation costs. So all costs which have been incurred till the date the asset is put to use should be included in cost of acquisition. So that is the cost of acquisition. Now what do you mean by estimated realizable value? See, we know that The management knows by experience that when you purchase a machinery, they know by experience that this machinery will give me life for the next 10 years because based on their past experience. They also know that when the machinery becomes useless after a few years, after the end of its useful life, it can be sold as scrap. And they also have information to estimate its scrap value when it comes to the end of its useful life. So the money which the company expects to realize when the asset becomes useless after the end of its useful life is called as the estimated realizable value, or in simple terms it is also called as scrap value. Now, what do you mean by estimated useful life? It is the period over which we expect to receive benefits from the machinery. That is called as the estimated useful life of the machinery. So the formula to calculate depreciation for 1 year is very simple. It is cost of acquisition of the asset minus estimated realizable value divided by estimated useful life of the asset. See, I'll give a simple example to understand this point. Let us say we have acquired a building by spending 22 lakhs rupees today. We have acquired a building today by paying 22 lakhs rupees, and we know that it is going to give me a life of 20 years. For the sake of calculation, I am making the life less. It gives a bigger life actually, it gives a longer life. Let us say the building was purchased today for 22 lakhs. It has a life of 20 years, and we know that after 20 years when the building is demolished, we will get a lot of iron, we will get a lot of rubble, wood, wire, which can be sold in the market, and it would realize at least 2 lakhs for us. With this information available, can you help me to calculate the depreciation on this building? The cost incurred was 22 lakhs. We know that after 20 years, we are going to get back 2 lakhs. What is this 2 lakhs? The money which we are going to get because of the scrap value. So, we are going to spend today 22 lakhs. After 20 years, we are going to get 2 lakhs back. So, during these 20 years period, we are going to lose only 20 lakhs. So, for a period of 20 years, we are going to lose 20 lakhs rupees. So, what is the loss per year? The loss per year was 1 lakh rupees. We can substitute the example in our formula. Cost of acquisition was 22 lakhs. The estimated scrap value was 2 lakhs. And the life was 20 years. So 22 lakhs minus 2 lakhs is 20 lakh rupees, and divided by 20 years, the depreciation comes to 1 lakh rupees per year. So every year we are going to lose 1 lakh rupees as depreciation. Now, technically, cost of acquisition minus estimated realizable value is called as depreciable value. What is it called as? Depreciable value. Cost minus scrap value is called as depreciable value. So depreciable value of the asset is 20 lakhs. It has to be spread over 20 years. We have to allocate the loss over its useful life. 20 lakhs is our loss. We have to spread it over 20 years. So the loss per year is 1 lakh rupees. Per year is 1 lakh rupees. Let us say in a particular year, we have been able to use the asset only for a period of 9 months. Let us say the building was purchased on 1st April, not on 1st January. And during the calendar year, we have used the asset only for 9 months. Then how are you going to charge depreciation? In such a case, what we will do is, depreciation to be charged for that year will be depreciation per annum 1 lakh into 9 months divided by 12 months. So 1 lakh into 9 months. What is this 9 months period? This is the number of months for which we have used the building in this year. And 12 months is the total number of months in a year. Or I can show you the same calculation in a very simple manner. For 12 months, the depreciation amount is 1 lakh. So for 9 months, what should be the amount of depreciation? It will automatically arrive again at this number. So depreciation for 1 year is calculated by this formula. You want to know what is the depreciation to be charged to the P&L account for a particular year? You have to calculate depreciation per year multiplied by number of months for which you have used the asset during the year divided by 12. Okay. Now, if you have used the machinery for full 1 year, then no problem. It will be 12 by 12. You need not do this calculation. You can simply take 1 lakh rupees. So I hope you have a reasonable understanding of the straight line method of depreciation. Now what I will do is, I will do one problem and I am going to show the accounting part of depreciation also. Okay, just continue with me. We will do a problem on straight line method. Cost of the asset, let us say it is 44 lakhs. The asset was purchased on 1st January 2012. Life of the asset is 4 years and scrap value is 4 lakhs rupees. There is an asset which was purchased at a cost of 44 lakhs rupees. It was purchased on 1st January 2012. It has a life of 4 years and its scrap value at the end of its useful life is only 4 lakhs. Now, can you help me in calculation of depreciation for this problem? I hope you remember the formula is depreciation for 1 year is equal to cost of acquisition 44 lakhs minus scrap value 4 lakhs divided by estimated life 4 years. So it will be 44 lakhs minus 4 lakhs. 40 lakhs is the depreciable value of the asset divided by 4 years. The depreciation per year is 10 lakh rupees per annum. Okay, so I think the calculation becomes very simple for you. Now how to show the asset account in your books of accounts, that also I will show you now. Now what you can do is, when you are seeing the video, I think you can even record these in your notebook. And now I will show you how to do accounting for this particular asset. I will prepare the asset account for you. This is the asset account, debit, credit, particulars, rupees, particulars, rupees. Now, when was the machinery purchased? The asset was purchased on 1st January 2012. We paid 44 lakhs and purchased the asset. What is the entry you pass when you purchase an asset? The entry we pass is asset account debtor to cash. See, it will be a joke if you say that you have paid 44 lakhs rupees cash to buy an asset. So we have given a check, let us assume. So we have purchased an asset and we have issued a check for 44 lakhs. What is the entry you are going to pass? The entry you are going to pass is asset account debtor to bank account. Asset account has to be debited on 1st January 2012 to bank 44 lakhs rupees. So we have debited the asset account with the cost of acquisition. Now, at the end of the first year, let us say the firm is following accounting period as the calendar year, or calendar year is the accounting period. So the first accounting period will end on 31st December 2012. On 31st December 2012, we have to provide depreciation. I hope you remember, I have already discussed the entry for depreciation. What is the entry you pass for depreciation? The entry is depreciation account debtor to asset account. So depreciation account has to be debited, asset account has to be credited. So I will credit the asset account. 31st December 2012 by depreciation. Now what is the amount? I think we have already calculated. Depreciation for each year is 10 lakhs rupees per annum. So you have to pass an entry. Depreciation account debtor 10 lakhs to asset account credit 10 lakhs. So we are going to credit the asset account with 10 lakhs rupees. So this is the entry we have passed. So depreciation account to asset, and then we have to pass one more entry, P&L account debtor depreciation. Depreciation will be debited in the profit and loss account as a loss. Okay. Now what will be the closing balance in this account? Let us balance this account also. 44 lakhs. 44 lakhs by balance carried down, it will be 34 lakhs. Now, so the balance left in this account is 34 lakhs. It has to be brought to the higher side. 1st January 2013 to balance brought down, it will be 34 lakhs. So we have gone to the next year. So the opening balance the next year is 34 lakhs. Again, this accounting period will end after 12 months. On 31st December 2013, we have to again pass an entry for depreciation. The entry we are going to pass is depreciation account debtor to asset account. Asset account has to be again credited by depreciation. It will be again 10 lakhs rupees. Because we said in SLM method you have to calculate depreciation only once. And in this year we have used depreciation for full year. Again in this year we have used the asset for full year. So we have to charge 10 lakhs rupees here. Now what will be the balance now? It will be 34 lakhs is the total. 24 lakhs is the balance. 31st December 2013 by balance carried down. Again 24 lakhs. Now we will bring it down to the next year. To balance brought down. 1st January 2014, 24 lakhs. This accounting year will again end after 12 months. 31st December 2014, again we have to write the entry by depreciation, 10 lakhs rupees. What will be the balance left in the third year? 24 lakhs. Minus 10 lakhs, it will be 14 lakhs rupees only. So by balance carried down 31st December 2014. So we have prepared asset account for 3 years. If you see, the depreciation has remained the same every year. It is 10 lakhs. 10 lakhs is 10 lakhs. That is why this is called as the straight line method, or it is called as the fixed installment system. Now we have to prepare the asset account for one more year. So because the space is not sufficient, I will go to the top of the page. January 2015, that is the 4th year, last year in the life. To balance brought down, it is 14 lakhs rupees. This is the remaining value. Now this year will end after 12 months. 31st December 2015 by depreciation. We'll write 10 lakhs rupees again, full year depreciation. Now if you observe the asset account now, 14 lakhs minus 10 lakhs, only 4 lakhs rupees is left. What is this 4 lakhs rupees? You remember when we started the problem, the estimated scrap value of the asset was 4 lakhs. If you observe the account now, 14 lakhs minus 10 lakhs, only 4 lakhs is left. 4th year of the life is also over. So there is no more life left. The asset has come to the end of its useful life. So what is left in the account? Only scrap value. So we have to now sell away the asset as scrap, and let us assume we have received exactly 4 lakhs rupees when we sell away the asset. We have sold the asset and we have received 4 lakhs rupees. What is the entry we pass? Asset is going out, real account going out, credit 4 lakhs and debit the bank account with 4 lakhs. So we credit this account with by bank 4 lakhs rupees. What is this? This is the scrap value which we have realized now. If you observe, the account will come to a close. The account tallies. account balance has become 0. This is called as the straight line method of depreciation.